Happy Monday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. Let's jump in. And first up, Beijing has condemned US President Donald Trump's latest threat to impose 100% tariffs on Chinese exports, warning that the United States is pushing the two countries toward renewed economic confrontation. As we've been following in recent days, trade and technology tensions between Washington and Beijing have entered a new phase, this time centered on critical minerals that underpin modern defense and industrial supply chains. On my other channel, China Update, we'll be looking at the implications for China. Spoiler alert, it could be very devastating for them. On Market Update here, we will look more on the US side. In a statement on Monday, China's Ministry of Commerce accused the US of reneging on the, quote, truce, end quote, reached in Madrid last month, when both sides agreed to resume dialogue on trade and industrial policy. On Friday of last week, the US president said his administration would impose large-scale export controls on, quote, virtually every product they make, end quote, including critical software, beginning the 1st of November. The announcement came hours after Beijing unveiled its own sweeping new restrictions on exports of rare earths and related technologies, a move that rattled global manufacturers dependent on Chinese supply chains. Behind the rhetoric, the US government has been quietly stockpiling strategic metals essential to defense technologies, from fighter jet components to missile guidance systems. Public filings from the Pentagon's Defense Logistics Agency, DLA, reveal plans to acquire up to $1 billion in critical minerals, including cobalt, antimony, and tungsten. Regular viewers may recall that one of the sponsors I worked with back in April was a North American tungsten mining company, and I argued back then that the US-China relationship would lead to a surge in investment and demand in these kind of companies. Since that sponsored feature was on the channel, the company's stock price is up 200%. Now, many of these materials are dominated by Chinese producers, leaving Western supply chains acutely vulnerable. One former defense official speaking to UK-based The Financial Times reportedly said, quote, "This is a delicate and expansive effort. They're looking for more and new sources of different ores needed for defense products." End quote. The $1 billion figure marks a sharp acceleration from previous efforts, part of the Trump administration's broader $7.5 billion One Big Beautiful Bill Act, which includes $2 billion for the National Defense Stockpile and $5 billion to invest in domestic supply chains. Prices of key minerals have already surged. Germanium, used in night vision and fiber optic systems, has skyrocketed amid falling Chinese exports, while the price of antimony trioxide has nearly doubled in the past year. Analysts warn of, quote, panic, end quote, in some Western markets as buyers scramble to secure suppliers. Meanwhile, for the automotive industry, a central pillar of American manufacturing, the wider trade war is causing pain. Ford, General Motors, and Stellantis expect a combined $7 billion hit to earnings in 2025 due to higher import costs and disrupted supply chains. In Michigan, home to over 1,000 auto parts suppliers, small and mid-sized firms are reporting cash flow crises and cancelled orders. Quote, "There's definitely distress," end quote, said Patrick Anderson, head of Anderson Economic Group in Detroit, adding, quote, "and the full effect of tariffs hasn't even hit yet," end quote. Executives warn that decades of global integration cannot be undone overnight. Quote, "We just don't have the manufacturing footprint anywhere to produce everything we need to consume here in the United States," end quote. Ford's CEO called the 25% levy on imported car parts, quote, "a $2 billion headwind that really restricts our future investment," end quote. Meanwhile, Chinese equities slumped on Monday today while bond futures climbed, a sign of investor unease over renewed trade tensions. The Hang Seng China Enterprises Index dropped as much as 2.4%, dragged down by heavyweights Alibaba and Tencent, while the CSI 300 index of mainland shares slid 2.7% before pairing losses. The People's Bank of China, meanwhile, strengthened its daily currency fixing to the firmest since November last year to steady the currency. The sell-off followed months of strong gains fueled by optimism in China's technology sector and confidence in Beijing's policy support, especially for AI. Trump's threat to impose 100% tariffs on Chinese goods reminded investors of the fragility of the recent trade calm. Even so, Monday's losses were milder than the 6.1% drop in the Nasdaq Golden Dragon China Index on Friday, as some investors viewed the decline as a chance to by the dip. Analysts said market volatility is likely to persist, but downplayed the risk of deeper damage. Quote, China's diversified export base and swift policy response mean the broader impact is contained, end quote, said an analyst with Pepperstone Group. Semiconductors and rare earth producers outperformed, with SMIC shares jumping over 6% as investors bet Beijing will accelerate technology self-sufficiency efforts, or at the very least will pump these companies with stimulus. China's real pain will be felt not in the financial markets, but with the real economy, where there is much more to be concerned about. We'll be discussing that in much more detail in today's episode of China Update, which comes out about 90 minutes after the release of this video. And finally for today, we move to Europe. FTSE Russell will reclassify Greek equities as developed market assets in 2026, capping a remarkable economic turnaround more than a decade after Greece's debt crisis nearly forced it out of the euro. The decision, announced in recent days, will take effect on September 21st, 2026, ending the country's decade-long tenure as what is referred to as an advanced emerging market. The Athens Stock Exchange reacted positively, rising as much as 1.4% after the announcement and extending its year-to-date gain to 42%. The upgrade is expected to draw greater international investment as funds tracking developed market indexes become eligible to buy Greek shares. The finance minister hailed the move as a milestone that, quote, creates new opportunities, end quote, for listed companies and strengthens the competitiveness of Greek enterprises. He said it also reflects the, quote, robust performance, end quote, of an economy that has emerged stronger from its fiscal trauma. Once the euro area's most fragile member, Greece is now among the better fiscal performers. It was one of only 6 EU countries to post a budget surplus in 2024, with another expected in 2025. The government has repaid its IMF bailout loans early and is planning similar prepayments of EU rescue funds. In March, Moody's restored Greece's credit rating to investment grade, citing its improved fiscal discipline and resilience. At a time of so much bad fiscal news across the world, these are all very positive developments and a powerful signal to the likes of, say, the UK and particularly France that fiscal discipline is possible and can bear fruit. The CEO of the Athens Exchange called the FTSE Russell decision a, quote, landmark achievement, end quote, that validates years of reform and modernization. Since being downgraded to emerging status in 2015, the Athens index has surged nearly 300%, more than double the return of the broader SMIC emerging market benchmark. The upgrade comes as Euronext NV pursues an all-stock offer to acquire a controlling stake in the Greek exchange, a deal its board says will bolster market resilience and deepen integration with Europe's financial landscape. Okay, that is today's episode of Market Update. If you got some value, don't forget to hit the like button. Consider subscribing if you want to continue to be on major updates in global markets. Have a good Monday, have a productive week, and I will see you for another episode tomorrow.